Hey everyone, Steve here, and welcome to The Explainer. Look, the closing bell just rang on a Wednesday that is absolutely going to go down in history as the Super Bowl of market volatility. If your portfolio feels like it's caught in a vice grip right now, believe me, you are not alone. Today, we're breaking down a completely chaotic close that has, frankly, redefined the entire 26 trading landscape. We are watching a market caught in this massive structural squeeze. On one side, you've got the Federal Reserve's incredibly messy final stand under Jerome Powell. On the other side, a geopolitical deadlock that is lighting an absolute fire under the energy sector. And sitting right smack in the middle is a massive Mag 4 earnings dump that just tore up the rulebook for the AI trade. So grab a notepad, let's dive right in and assess the raw damage. Plus 7.3%. Just let that number sink in for a second. That is the staggering intraday rip we just witnessed in oil. Guys, this isn't just your run-of-the-mill market fluctuation. This massive spike establishes the sheer systemic pressure that is driving all of today's market nausea. When you have a commodity as absolutely crucial as oil spiking this violently in a single trading session, it sends shockwaves through literally every other asset class. Right now, it is the undeniable gravitational pull of the entire market. Okay, let's run through the evening ledger real quick to see exactly how this played out. The tape data brilliantly illustrates this crazy tug-of-war we saw today. The equity markets were wobbling hard as the sheer weight of $100 oil finally slammed into the reality of a hawkish Fed. The S&P 500 managed to close just above 7,131, slipping slightly but totally failing to hold those record levels we saw earlier in the week. Now contrast that slight slip in equities against Brent crude, which ripped up over 7% to nearly $120 a barrel. Meanwhile, gold took a heavy sell-off, dropping down to $4,732, and Bitcoin, well, it's yellow flagged right now, testing support just over $77,400. So the contrast here is just incredibly stark. Equities are hanging on by a thread, while the energy sector is staging a decade-high surge. To really grasp what's happening, you just have to visualize the Brent crude chart. We are talking about a massive, aggressive green candlestick that completely shattered expectations, settling all the way up at $119.34. I mean, this is the highest level we have seen since 2022. The volume, the aggressive displacement away from the moving averages, it's wild. This price action is the direct fallout from a total breakdown of expectations over in the Strait of Hormuz. The market is suddenly pricing in absolute worst-case scenarios, and it's doing it with terrifying velocity. So what's actually fueling this rocket ship? Pure geopolitical gridlock. The main driver for that 7% rip is what's happening, or well, what's not happening, in the Straits of Hormuz. Tehran proposed reopening the strait, but Washington essentially gave them the cold shoulder. You had President Trump urging Iran to get smart soon, while Secretary of State Marco Rubio made it crystal clear that the U.S. is not about to let Iran control that critical shipping lane. And honestly, the power plant ultimatum, which is the standing threat to decapitate Iran's domestic power grid, is literally the only reason the global oil tanks haven't gone totally dry yet. Add in the UAE's sudden exit from OPEC, which is shaking up the entire global energy order, and we are sailing in completely uncharted waters right now. But hey, let's pivot from the global conflict for a second and talk about what's happening domestically. Because the market is being squeezed from both ends here. We've got two massive domestic anchors weighing us down. On one side, you have Jerome Powell's very messy final stand with a deeply fractured Fed that's holding rates hawkishly. And on the exact opposite side, you have the Mag 4 earnings shock, where big tech is suddenly choking on this massive AI capital expenditure burden. These two huge forces basically collided head-on at the 2 p.m. 0 hour today.
Let's break down that Fed side first. 4. That is the magic number you need to remember here. There were 4 dissents at today's FOMC meeting. Yes, the committee voted to hold rates at 3.50 to 3.75%, but those 4 dissenting votes, that's the most dissents we have seen since 1992. This was Powell's final press conference before Kevin Warsh is expected to take over the seat. And frankly, it was a complete mess. It reveals a deeply fractured Federal Reserve that is essentially handing over the reins in a state of internal civil war, and it's happening right when the market desperately needs some clarity.
And then the bell rings and bam, we get the big tech choke. $650 billion. That is the staggering price tag of the AI capital expenditure signaled for this year by Alphabet, Amazon, Meta, and Microsoft. All 4 of these giants dropped in after-hours trading. Now, yes, the revenue beats were technically there on paper, but the market is choking on that massive capex number. Listen, if artificial intelligence doesn't start paying the rent, and paying it soon, that $650 billion is going to look like a mountain of very expensive paperweights in our current high-inflation environment. The 2026 AI trade just hit a massive reality check. All right. Let's step away from the macro news and just look at the raw technicals. For the S&P 500, we finished near 7,131, but the key level to watch is the 50-day exponential moving average, which is sitting way down at 6,792. Below that is your absolute ultimate floor, the 200-day simple moving average at 6,706. So we are still nearly 6% above that 50-day floor. But what's really terrifying about this setup is the sheer amount of open air between our current price action and that support. It is a 6% vacuum, and with today's catalyst piling up, that vacuum is starting to pull really heavily on the index.
And if you want confirmation of that downward pull, we need to talk about a major technical red flag, the Commodity Channel Index, or the CCI, specifically the 20-period CCI. Right now, it is printing an incredibly overbought reading near plus 140. When the CCI pins the needle this high, right at the exact moment the S&P 500 is retreating from record highs, you are looking at pure statistical exhaustion. The current upward momentum is entirely dead. The rubber band has been stretched as far as it can mathematically go, and guys, it is snapping back.
So where do we go from here? The battle lines for tomorrow are drawn perfectly clear, and market sentiment is incredibly polarized right now. First, let's look at the bearish case. Honestly, it's grim. We're currently trading on the hope of a ceasefire that simply hasn't been signed yet, all while Brent crude is practically knocking on the door of $120. If the Iranian power grid actually gets hit, or if tech earnings miss tomorrow, the regression back toward that 50-day moving average at 6,792 is going to be incredibly violent. Now, on the flip side, you have the bullish case. The peace dividend bulls out there believe the power plant threat is going to force a total Iranian surrender by Friday's open. If a deal is actually struck, the trading algorithms will trigger a massive squeeze, driving the S&P 500 rapidly towards 7,200.
Listen, when the warships are active and the Fed is fractured, capital preservation is literally the only trade that matters. So here is your strict, no-nonsense checklist for navigating tomorrow's chaotic opening bell. Step 1. Respect the 6,800 support. That 50-day moving average at 6,792 is your primary line of defense. If we lose that level, get out of the way. Step 2. Watch the CCI. If that indicator crosses back under 100 tonight, the momentum is officially dead. And step 3, monitor $115 on Brent crude. As long as oil remains above that benchmark, the inflation trade owns the ball. Keep your position sizes small, keep your stops tight, and absolutely do not trust any peace headlines until those oil tankers are physically moving through the strait without military escorts.
Because tomorrow brings the ultimate zero-hour trigger, April 30th. Apple reports tomorrow right after the bell, rounding out the Mag 7. So I want to leave you with this final provocative thought. Will Apple's earnings be strong enough to hold the entire tech floor, or is the great 2026 AI trade finally broken under the immense weight of inflation and geopolitics? If Apple misses, that floor is entirely gone. Stay disciplined out there, watch your averages. This is Steve. Thank you so much for joining this explainer, and I will see you tomorrow for the 0-hour update.